Good afternoon. Good afternoon. I hope everyone had an enjoyable lunch. We do know that it's a little frosty in here, and they're working on that. So before anyone says anything, I already mentioned it, so they're working on that. My name is Pam Hunter, and I am a state assembly woman from the proud great state of New York, New York. And I am also the NCOIL treasurer, and I'm going to be moderating this general session here this afternoon. We have a great panel of speakers with us here today to conclude our year-long series of general sessions dedicated to ESG public policy. As a reminder, our first session in March served as an introduction to ESG with a substantive focus on environmental policy, the E part. The second session in July focused more on social elements, and today's third and final session will explore governance aspects and serve as a summary of the series. I do think the series has been very beneficial as we've been able to bring together a wide range of experts to address the challenges and opportunities presented by all different types of ESG public policy, and I want to stress because we heard all different types of ESG public policy. This series is intended to be educational in nature, and we've heard and we'll hear more today about different types of policy in an effort to be aware of everything when we likely deal with these issues in our legislatures. In your binder, starting on page 203, and on the website and an app, you'll see different types of ESG policy in states such as Texas and Illinois. Before we do get started, I'd like to stress the need for all of us to be respectful of different perspectives we'll hear during this session. We have done a good job in the series of being respectful overall, but I want to make sure that we finish the series in the best possible way. And we received information in our binders as a reminder from NCOIL President Ferguson about the same. So joining us today to discuss these issues are George Nichols, President and CEO of the American College of Financial Services, Roosevelt Mosley, Principal and Consulting Actuary at Pinnacle Actuarial Resources, Jim Copeland, Senior Fellow and Director of Legal Policy at the Manhattan Institute, and Huey Newsome, Chief Financial Officer at the Piston Group. And you can look in your program to get the bios of each one of these fine individuals and also on the app. If you want to learn more about them, please feel free to reach out to them after. The format for this, just like every other session, we will hold all questions until all the panelists are finished speaking. We have allocated an hour and a half for the session, so speakers, if you would kindly, we're going to give you 15 minutes, and we have Pat here to make sure we stay to the 15 minutes. I'll remind you if you're going to be close to your 15 minutes because we want to make sure we leave plenty of enough time for my fellow colleagues to be able to ask questions to get some feedback from you. So with that, if we could start with Mr. Nichols, please, then we're going to follow by Mr. Mosley, Copeland, and Newsome. Thank you.
Thank you. It's an honor to be here. I'm a former insurance commissioner, regulator, so it's nice to be here as an educator and not as a former regulator or current regulator, even though I'm glad to see the relationships have been really developing over the years. I'd like to sort of explain the perspective of which I would share. I represent the American College of Financial Services. Our primary focus is providing professional designations to financial advisors, certified financial planning, chartered life underwriter, retirement specialist, special needs, most of those that are on the life insurance, banking, investment side of the business. We've been doing that for about 97 years based out of King of Prussia, Pennsylvania, the Philadelphia area. We also have centers of excellence, and those centers of excellence are centers that focus on thought leadership around various subject matters, and ESG is probably one of those that we spend a lot of time in our center around ethics. And because ethics addresses many of the issues related to governance. We spend a lot of time working with companies across the country, working with senior leaders, talking to them about the approaches that they take. So the perspective that I want to share is really at a very high level of what we have tried to talk to executives about in terms of their role as leaders, but also some of their board members as it relates to their governance. I'll also mention that I am on 2 publicly traded boards. I am involved in the governance committees on both of those boards. I'm involved in risk management on both of those boards, so I also have a perspective as a board member as we deal with ESG. I would say that you know very well that we in the ESG space are at a crossroads. And there's the challenges, I think, obviously, of the political issues that are being discussed, but also the regulation. When you think about the disparate approaches to what companies are having to deal with as it relates to the regulations across, from a global perspective or even nationally, that becomes challenging by state to state. So that's one issue that they deal with. And then the political approach that's being taken is also another challenge. And it doesn't matter which side of the aisle that you sit on, that becomes another issue that companies have to face. But I actually would go back to the Business Roundtable a couple of years ago, talked about the expansion of the stakeholders that a company has to deal with. And that, yes, as a publicly traded company, your responsibility is to shareholders. But at the end of the day, if you don't understand how you run your organization from a truly governance perspective, that there are broader stakeholders than just meeting shareholder responsibilities for the long-term benefit, that becomes a challenge. But I felt like the Business Roundtable's decision made so much sense. So when you look at ESG from our perspective, if you were to agree that there's a broader set of stakeholders that a company has to deal with beyond just its shareholders, then you realize that you have to take in consideration ESG. If there was a study done by the Harvard Law Forum, and they actually had the best saying that I've read about as I've done my research on this. I wish we could change the letters from ESG to GES, because this really is a governance issue. And that's really where it should sit. In that regards to ESG should be a part of your business strategy. And that's where you make that decision, is the business strategy. And how does it fit? And that is why I raised the issue around stakeholders, because if my strategy involves consumers, if my strategy includes the recruitment of talent, and that talent is diverse, then I have no choice but to deal with the social issue. If my business strategy is related to something that would have an impact on the environment, then I have to incorporate that into my business strategy. Every one of those issues should be dealt with by the management and leadership and the governance of that company. And it doesn't change whether or not government plays a role in setting the rules. Ultimately, one of my stakeholders being shareholder return, I have to think about all of those in totality as we go through making decisions. Because some of the other challenges that ESG brings that I think companies are forced to deal with from a governance perspective and a leadership perspective is the impact that data is having. Just imagine the amount of data that, as we are getting more focused in on understanding the impact of big data, now imagine overlaying that with AI. AI is going to bring another set of issues that companies are going to have to deal with, and that goes up to the governance perspective, that goes up to the leadership. Then you take in consideration, again, as I mentioned, the regulation. That now is another factor that leadership has to take into effect, and also the board and its governance structure has to. And then there's this whole digital and technology implications that you have. So you have all these factors, and then this recognition that depending on what my business strategy is, I have to think about the true expansion group of my stakeholders and who I'm ultimately responsible to. So when companies are thinking about it, they're hoping that from a leadership, from a legislative perspective, the roles that you play in your states, the roles that you may have giving input to your leaders that are at the federal level, is how do we find the right balance, irregardless of where one sits politically, but how do you find the right balance that there are issues that all of us know we as corporate citizens have to participate in, but also getting back to ultimately the business strategy and our ultimate responsibility to the stakeholders of which the company represents. I believe also that it is appropriate that companies would have to report, but trying to get a sense of what that reporting is. And it shouldn't be dictated based on what one person has over another, but again, I'd rather see it tied back to the business strategy of what I'm responsible for. Because depending on what that strategy is, I may weight more in one of the letters than I would in the others. That's really what I wanted to share. Again, from our perspective, I do recognize that this is at a crossroads. I commend you for having this conversation. But as you go forward and you think about it, the hope really is that as you determine what you think is right for your community, for your state, that you also recognize ultimately, whether you're publicly traded or not, there is a business strategy. There is a recognition that all three of those letters, there are implications on a company's business, and having the ability to try to address those is going to be important, whether it's serving my customers or trying to get talent or my shareholders. There is a broader context, and so the goal is hoping that you take all of those things in consideration as you go through making public policy. So thank you very much for the opportunity to be here.
Thank you, sir. Mr. Mosley?
Thank you for the invitation, and thank you for the opportunity to share a few comments on today on this topic of ESG. As a bit of background, I am Roosevelt Mosley. I'm a principal with Pinnacle Actuarial Resources. I've been involved in the actuarial space and property and casualty work for over 30 years now. I've also, for the last year, served as president of the Casualty Actuarial Society. And I bring that up because I think that may have some aspects that will contribute to some of the discussion today. So the perspective I bring is certainly from an actuarial perspective, but how that actuarial perspective can potentially provide insights and can lend some analytic expertise to some of the things that you're thinking about and some of the things that you're considering as you consider some of the topics related to ESG. Also, as part of my work with the Casualty Actuarial Society, we're actually going through a governance process right now, and so we've been focused squarely on some of the issues of governance and how those relate to, as Mr. Nichols described, our ultimate stakeholders, not just our members, but those customers that we serve. And I also have served on a board of insurance company board of directors, where I also again was focused on some of these governance issues, and I will build actually off of what Mr. Nichols described, because if you really think about a lot of the issues related to the E and the S, the environmental and some of the social issues, a lot of it does come down to a governance question, both a governance question related to how those issues are being managed internal to a company, but also how then it is those issues are being managed to the stakeholders that are external to the company. I originally was scheduled to be part of the Minneapolis discussion on the S, but due to actually a flight cancellation, I wasn't able to make it, and so so some of my comments will incorporate some of the social aspect, but relate also to the issue of governance. Certainly from the actuarial perspective, we tend to focus or come at this maybe from a little bit more of an analytical approach. But one of the things as we've been involved in a number of these issues related to some of the social issues being raised related to insurance, one of the things that we've recognized pretty quickly is that the issue of governance is a really key one in terms of addressing some of the issues. At Pinnacle and also at the Casualty Actuarial Society, we've been involved pretty heavily in issues related to obviously climate risk and what that means for customers and what that means for the companies that we serve, the regulators that we serve. We've also been pretty significantly involved in some of the issues related to fairness and potential for bias in rating and insurance practices. And there are a couple of aspects I want to highlight there and really draw them back to the issue of governance and again, offer some things for you to consider as you think through some of these issues in your states. First, one of the initial challenges that we've seen in terms of the issue of fairness, and even before I get there, let me back up and say as Mr. Nichols highlighted, the meteoric rise of data, the meteoric rise of technology, of AI, of our ability to consume, analyze, and deploy the results of that analysis has grown substantially. And with that, the potential for challenges have arisen. And so we certainly understand that potential for challenges exists. But when a lot of the discussion around fairness happens, a lot of the discussion around potential bias happens, oftentimes there are a number of stakeholders involved that really aren't thinking about it in the same way. A lot of people may use the words related to fairness, but when you really get down to it and try and define what that means, a lot of those definitions may vary. It could relate to social fairness, it could relate to actuarial fairness, potentially to things like affordability or availability. All of those are important issues that need to be addressed. The challenge is when those issues become conflated and solutions are proposed that attempt to address one or two of those issues, but don't really address the totality. Though those challenges can create some difficulties in terms of how those issues are really truly addressed or not. And a lot of that I think comes back down to how the governance of the issues and how the governance of the even defining the problem is handled. So the clarity of definition is one of the challenges that I think is important. As you go through the process of defining some of the challenges that we're trying to solve, one of the other aspects is being more diligent about applying some. I think there are tools out there, there are approaches out there that will help us to help us understand whether some of the things that we're concerned about are happening related to fairness, related to bias. And to the extent that we are able to define what it means, the test can be done in a way that can help us determine whether that's true or not. But again, the challenge is at some point, a line is going to have to be drawn in terms of what's potentially fair and what's potentially unfair. And where you draw that line has significance not only for the insurance company, but also the stakeholders, consumers, et cetera. And so deliberate understanding of the implications of where you draw the lines of fairness, I think are also going to be really key. And there are ways to understand the implications of different places where you could potentially draw those lines. And then ultimately it comes back to, if you bring it back to the idea of governance, a lot of it does come back to how companies address this issue, both in the eyes of the key stakeholders internally, but their external stakeholders, the consumers, the regulators, et cetera. And to the extent that this is able to be addressed in a collective manner that balances a lot of the competing interests here, I think it does ultimately end up in a better place for that ultimate stakeholder, which are the consumers that the insurance companies strive to be there for at some of their deepest times of need. And so I will leave my initial comments there, but happy to answer any questions as we go through the discussion.
Thank you. Mr. Copeland?
Thank you, Madam Chairwoman, and thanks for having me here at NCOIL. I mean, my bio's in the packet, but just a little context here. Of course, the Manhattan Institute is a nonprofit, nonpartisan think tank in New York, and I, for the last 20 years, have run our legal policy program, which involves a host of law and economics questions, from civil litigation to corporate criminal investigations, administrative law, and corporate governance, securities regulation. The latter ones sort of dovetailing here. So I come at this issue from a little bit different perspective. Mr. Nichols was sort of talking about this from a business strategy perspective, ESG factors, and Mr. Mosley more from an actuarial perspective. And I look at this more from a capital markets investment perspective and the regulatory regime governing capital markets investment and looking at this. So we a little over a dozen years ago set up a publicly available web database, proxymonitor.org, and we sort of track and allow characterization and study of shareholder proposals filed under what's called Rule 14A8, promulgated by the Securities and Exchange Commission pursuant to the Securities Exchange Act, which is what enables shareholders, is the rules enabling shareholders to put proposals on the proxy ballots of publicly traded corporations. And we did this because we saw a growth in the number of these, and a growth in the number of these particularly concerning social and environmental issues. And we wanted to study and understand that, look at trends, and try to unpack it. And so, you know, I agree fully with Mr. Nichols that I think it's important to sort of unpack this E, S, and G. I mean, they're sort of lobbed together. And my argument has always been that governance is a classic sort of shareholder voting concern. And by that I mean process of governance. So how do you elect your directors? How often do you elect your directors? Do you separate the chairman and CEO? How do you call special shareholder meetings? These sorts of questions are regularly on corporate proxy ballots, and they govern sort of the process of how shareholders protect their rights through the voting process, and in addition to the fiduciary duties on boards of directors of publicly traded corporations. They're a little different from substantive sort of governance questions, and there was a little bit of a conflation, I thought, in the way Mr. Mosley was talking about that, which is sort of like, what are the decisions that the actual boards and the managers of the companies are making? And I agree with Mr. Mosley that, you know, clearly we have shareholder primacy in terms of what are the fiduciary duties of corporate boards, but stakeholders matter. And I said this when the Business Roundtable came out with its statement of purpose, which was slightly changed from its old statement of purpose in 2019. I wrote about it in the Washington Post, that, you know, to some degree what they were saying was a truism. I mean, they weren't backing away from shareholder primacy, but they're saying, well, yeah, any business worth its salt is going to pay attention to its customers, to its suppliers, to its employees, to the general political environment, the community around it. So I think that's all correct. But I think there's a distinction between sort of that substantive decision-making on environmental or social metrics or other things, and sort of the governance procedural metrics in the way I sort of think about these and the way I analyze the proposals here. I mean, ESG itself is relatively new, although there are certainly antecedents going back. Social responsibility and socially responsible investing goes back decades. ESG itself traces to 2004, a report commissioned by the United Nations called Who Cares Wins? And it was subsequently adopted by a bunch of big banks around the globe, and by 2006 by the New York Stock Exchange. So it's a relatively 2-decade-old sort of thought process to call this ESG per se. And we've seen significant capital flows into it. It's not nearly to the degree in Europe, but here in the United States, until recently at least, we saw this as a significant growth in investing trends. So by 2020, Inflows into investment funds that were ESG related were about 1/4 of all new dollar inflows into mutual funds, which was double the prior year, up from just 1% in 2014. So that's been pretty aggressive growth. And from year-end 2019 to year-end 2021, we had an almost doubling of the assets that were ESG from about $276 billion to $550 billion in that 2 years. We've seen a retreat back to 460 cents, partly because there's been weak returns in the ESG funds subsequently, and partly because you then have withdrawals, which are, those are obviously related to each other. The regulatory structure here in terms of corporate securities law, I don't know how, those of you who aren't lawyers in the audience, I don't know how well you're aware. I mean, we generally have a dual regulatory structure. So securities law is regulated federally, and this is largely a disclosure-based regime. And then substantive rights of shareholders are governed at the state level, much like insurance, where corporate law is a state-based regime. And for a variety of reasons, Delaware is the dominant state in this. But obviously isn't guaranteed to have that, and there's been some change in the distant past in terms of where that will be located. The original shareholder proposal rule that the SEC promulgated in 1942, just a handful of years after the passing of the 33 and 34 Acts in the Depression, was specifically allowed companies to exclude shareholder proposals that were thought to have a, quote, general political, social, or economic nature. And that continued until the 1970s, at which time they basically inverted that position. So there's something called the ordinary business exclusion, where you can't put shareholder questions to the ballot that involve basically management choices. But now, if there's sort of a general social or environmental nature, it's the exception to that rule. And most recently, the SEC a couple years ago came out with new guidance saying that it doesn't have to be material to shareholder interests. So that's sort of the broader structure. Now, when I started writing about this and studying it, a dozen years ago, these were interesting, but they were interesting sort of because they were allowing the airing of these ideas in corporate annual meetings, not because you actually were getting affirmative votes. You were on some of the governance questions, for sure. But not on these environmental and social questions. So as recently as 2017, I could say, and I did in the Wall Street Journal, there's never been, among the 250 biggest publicly traded corporations since 2006, which is where our database tracks back to, there's never been a shareholder proposal that's environmental or social get majority shareholder support. Now that has shifted in the last 6 years, largely due to shifts in position from the large institutional asset managers, BlackRock, State Street in particular, as well as Vanguard, but BlackRock and State Street a little more so. And we saw that happening right around 2017. So State Street came out fairly aggressively on gender questions with their Fearless Girl statue in front of the Wall Street Bull in downtown Manhattan. BlackRock, a week later, sort of announced it was going to prioritize gender balance and climate risk and these sorts of questions. BlackRock CEO Larry Fink came out with a series of statements about social purposes of corporations, et cetera. So we've seen a shift in that, and a shift in the way the big asset managers have behaved over time. So unsurprisingly, there's been some sort of political pushback, right? I mean, I grew up in North Carolina, and I went to Dean Smith basketball camp and saw young pro player do dunk contests named Michael Jordan. And it's an apocryphal story during the 1990 U.S. Senate campaign, which was a big controversial campaign, but the basic thrust was true. The apocryphal story, which I don't think is accurate, was he said, well, Republicans buy shoes too. I'm not going to get involved, which is not necessarily the way professional athletes behave today, but it's the way it was behaved back then. And so corporations largely tried to stay out of this stuff. That's been far, far more difficult for them to do recently. And so as there's been some political valence on some of these questions, environmental and otherwise, coming out of the big institutional asset managers, many of which particularly BlackRock, State Street, and Vanguard are principally investing in passive investment vehicles. In other words, they're not buying and selling securities, trying to value those securities and make a concerted decision for or against management strategy. They're merely replicating the S&P 500 or another market index basket, and yet they're wielding increasingly substantial control over corporate board decisions through shareholder engagement. So it's not surprising that we've had books come out on this. My friend Vivek Ramaswamy, an Ohio guy, called the big three asset managers, BlackRock, State Street, Vanguard, arguably the most powerful cartel in human history. And the red state actors have gotten into this. They're really late to the game, though. I mean, New York City and state in particular, California, Connecticut, Philadelphia have long been agitating through the social engagement with the shareholder proposal process, et cetera. So we've seen shifts back, and we've seen some of the legislation here. I mean, we've got one sort of on both sides that relates to insurance here, Texas and Illinois. We can talk about it in more detail if we want, and question and answer. We've seen it also at the federal level. There was hearing this summer in the House Financial Services. I testified in front of it. You can see online my testimony. The Senate's had a bill that was also introduced in the House governing passive index fund investing. There's other model bills in the House, et cetera, and of course at the state level as well. So how do I think about this? I mean, there's no question that environmental issues, social issues, all these sorts of issues can be very important to business strategy, as Mr. Mosley was talking about. There's no question that these stakeholder interests can matter. That doesn't necessarily mean, however, that it makes sense to delegate questions to a plebiscite among all shareholders on these sorts of questions, most of whom are going to be uninformed shareholders. I mean, if you're investing in a passive index fund, you're uninformed. The passive index fund, by definition, isn't spending money. They're trying to keep their costs to a minimum. I mean, that's why they're so successful. They're not doing particularized research on any company. And so it tends to politicize the process. Financial theory would tell us, and I think the best empirical evidence would tell us, that it compromises investment returns. So, that I think is crucially important if you're talking about regulated industries or regulated pools of capital where those returns are crucial. So, for instance, pension funds. State pension funds are, of course, exempt from ERISA. Private pension funds governed by ERISA. I mean, I did a comment letter in September of 21 with the Department of Labor, and full disclosure, I am a current plaintiff against the Department of Labor, along with this state, 21 others, and a few other industry groups, suing the Department of Labor over that rulemaking on ESG factors and pension fund investing. But if you're talking about pension fund investing, and the same principles apply to insurance investing, investing the pool of assets to generate a return in your portfolio for your insurance companies. If you fail to get adequate returns due to misalignment of your investment strategy, that's going to compromise the solvency of your portfolio and generate additional risk, as it does in the pension context. So I think it's very important to get this right, and the fact that these are important factors, and they are, for businesses to think about, doesn't mean that you ought to have a sort of top-down approach or a plebiscite approach to handling them. And what's important to remember is that the market is already incorporating all of these factors. Hedge funds are trading and pricing these securities on the margin, considering every factor they can think of. They have hundreds of millions, billions of dollars on the line behind their decisions. And so to try to do this with a sort of matrix approach, which is often the way these things are done, I think is foolhardy from a policy matter. So I think it's something that policymakers should take seriously. Thank you.
Thank you, Mr. Newsom.
Thank you for having me this afternoon. Just a little bit of background on me. I think in the bio you saw Piston Group. So that is a private sector company. It is a privately owned company in the manufacturing space. But before my time at the Piston Group, I was also Chief Financial Officer for Wayne County, Michigan. So what I'm going to talk to you today is from a perspective of someone that's been in the municipal sector and also someone that's been in the private sector. And so what I'd like to also just point out as well, not only that, I also do a regular article on ESG for Forbes, Forbes Online, Forbes.com as well. But what I want to do today is talk about a few things, but I want to look at this from, a point of practicality, right? Someone that is living the life of these policies and also understanding the impact of these policies, both as a municipal, officer, but also as a chief financial officer for a company participating in an industry that is heavily involved in decarbonization, the automotive industry. So first, during my time at Wayne County, there was an increase, an uptick in the interest, in the interest of the impact and also the adaptation of municipalities when it came to decarbonization, right? And so there's been a huge push by the municipal bond rating agencies for ESG ratings and factors to be considered in bond ratings for counties, cities, states, et cetera. In fact, as I was leaving, we were working on doing a pitch to the rating agencies as it relates to ESG adaptation, ESG related adaptation, and impact for the county that I was in, and spend a lot of time kind of understanding what this meant. And I will say that, one of the more important things to think about when you think about ESG. And this translates not just in the municipal sector, but also into the private sector. Two things you want to think about. First is going to be adaptation, which the rating agencies really do, really do factor highly into their ratings, right? Which a lot of people will look at ESG as, okay, are you being responsible? Are you being socially conscious? But also, it's really a risk management tool when you think about what the rating agencies are looking at. They're asking, what is your plan, and what is your exposure to certain risks, and what are you doing to manage those, right? And so if you think about it from a municipality standpoint, ESG is very important for us to be able, I'm not going to say quantify, but at least measure where certain standards, whether or not a county is more prone to, say, wildfires, right? And that's very important for issuing debt. Will there be a cataclysmic event, and will that cataclysmic event lead to the inability to pay down on the bonds? That is the foundation of what ESG means, at least in the public sector in terms of bond ratings. But the other piece to it too, and on the public sector side, a lot of it because of the nature of what goes on in local and state government. The maturation of the use of that information, of ESG information, the development of that information, the use and consumption of that information, particularly for stakeholders that are municipal bond investors, is limited, right? Because if I live in a county, if I live in a state, I'm not going to I'm not buying a vehicle, I'm not buying a piece of clothing. What I'm doing is determining whether or not I'm going to live in that particular place. I'm not going to use those ratings to make that determination, right? So it's very important for us to think, when we think about ESG, to think about stakeholders and think about who's consuming the data for what purpose. Now, moving ahead to, going ahead to the private sector and working for a privately held company now, I'm going to speak about the automotive industry, not on behalf of my customers. My customers are publicly traded companies, right? So I won't speak on their behalf, but I will say that I have to be concerned about them as my stakeholders, because they are getting to a point where they have to provide certain information. And 90%, if you think about a vehicle, 90% of a vehicle's carbon impact is in the supply chain, not in final assembly. So I have a responsibility, as well as the rest of the participants in the downstream supply chain, to be able to measure and assess the impact of what I'm doing from a carbon standpoint. Not just from a carbon standpoint, more and more I'm being asked by my customers, what is your social impact? What is your access to labor rights? What are you sourcing materials from conflict zones? Do you have policies around, social responsibility, forced labor, et cetera? So I have to be able to address those data requests and be able to provide that data more and more and more as ESG related disclosures and requirements are coming from, again, going back to stakeholders, not just the general public in a more nebulous form, but also from regulators, as Mr. Copeland talked about, in a more formalized form. And so because of this, and I think the automotive industry is a very interesting sector. It is at the pinnacle of decarbonization. I'm talking a lot about decarbonization, climate change, but this also runs the gamut of not just the E, but also the S and the G, right? And so looking at it from that perspective, I think it's important for everybody. You can use this as kind of a canary in a coal mine, if you will, for other industries as well, because other industries are also dealing with those same questions. Not just a matter of what does the end product do, what's the impact of the end product and the use case of that end product in the market, but also how is that end product produced, right? So I'm producing an electric vehicle, but I'm producing an electric vehicle in heavy emission factories, sourcing materials from conflict zones, places where there are poor labor rights, things of that nature. We have to have a way to be able to talk about both, right? Not just the impact of the product, but also the impact of the supply chain and the process by which we produce that particular end good. So what I wanted to do, and be brief, as brief as possible, is talk about a few themes, right? I think the first thing here, and I think Mr. Nichols all three of the panelists did a great job of talking about this, really talking about the importance of transparency and disclosure, right? So when we think about what we're trying to accomplish with ESG policy, and let me take a step back. I think I will acknowledge that I don't want to get into the politics of it, because I know there are many political viewpoints on this, and politics is divisive. But I think that it is important that whatever we collectively agree on needs to be measured. We need to make sure that we have the ability to disclose. We have to have standards by which everybody agrees, and those standards have to be effective, right? What is it that we're understanding the stakeholder base? Who is it that we're trying, when we think about ESG policy, who are we trying to communicate, and what are we trying to communicate, right? So going back to my previous example, going back to municipal space, I've got a set of stakeholders that are trying to understand the risk profile of the municipality I am CFO over. In that situation, I have to be transparent about not only the impact of, say, government operations has on carbon emissions, but also the risk profile that my county, city, state has when it comes to climate change or other cataclysmic events that are related to the environment. So it's, to understand disclosure, right, and make sure that we all are talking that same language and being as transparent as possible with sources of information, assumptions, and all the things that are typical and required for someone like me that's involved in investor and stakeholder relations and reporting, right? So that's number one. I think the one thing I think that's important for you all to take away as well is that when you think about ESG related policy, think about the kind of a whiplash effect. When you do something on this end, it causes a huge amount of, I'm not going to say disruption, but I will say impact in terms of the day-to-day requirements of those that are responsible for providing data information, updating processes, updating data sets, and making sure that we have the ability to provide you information. Again, this works its way in for state and local governments. It works its way into financial services, in manufacturing. You think about when you set a standard or a policy around making sure that we can report on the emissions of a series of plants or say fleet vehicles for state and local government, that requires us to have ways to measure. Somebody has to put their name on that, so you have to verify that. So how are we going to measure? What standards are we going to use to measure? It has to be very clear when you're thinking about those policies, because it takes a lot of time, investment, training, process updates to make sure that we can provide that information clearly and consistently. I think it's also important to understand the importance, on cost, right? So these are very important things we're looking at now. We need to, again, I'm not going to get into the politics of this, but I think we can agree that we do need to address the impact of climate change, right? We do need to address whatever, addressing social ills is in terms of the impact that corporations have on those ills, state and local government operations have on those ills, whatever that is. We can agree on that. So with that being said, I think it's important that we also make sure that we do these, that we think about policy. We want to do them, we want to think about efficiency. We also want to think about making sure that we're cost effective, right? What's the right level of disclosure, as all the panelists have talked about? What are the right levels of disclosure? What are the reports that are necessary to provide those disclosures? How much, are we boiling the ocean? Are we being effective in telling a true story and being transparent, as I said before, or is this more information that's necessary? Because again, going back to my whiplash example, when one data point on a disclosure, say an SEC report, there might teams of people working hours upon hours to provide that one data point. That's brand new, that's never been done before. Significant amount of cost, particularly upfront cost to do it for the first time. These are things that I think are very important that you have to think about. And again, understand who's consuming this information, right? So, for a state and local government, you have a set of consumers of that information, but also if you think about, again, going back to manufacturing industry or other industries as well, you have policies that could be around, again, going around disclosures for investor relations, but you also have disclosures around end consumers, the consumers could be utilizing, right? So what is it that's important to those stakeholders, really understanding what those stakeholders need in order to understand what it is that they're seeking. But I think one thing I will, and I'm going to give State Senator Theus credit for this, I think I'm going to close with one important theme I think is super important. And I think that we need to all sit down and really ask ourselves, what is it that we truly want to measure? Let me give you an example of what I'm thinking about. So is it a matter of us measuring, again, going back to my world, percent of vehicles that are electric in the field, right? Are we looking at impact to climate? Are we looking at tons of carbon emitted in the air? What is it that we're truly measuring? What is the driver for that final impact that we're trying to control, right? And so there are a number of different ways for us to get to that. I can increase the number of electric vehicles in the field, but there's going to be a certain impact that I need to consider, the life cycle of those batteries, whether or not the minerals for those batteries are sourced in conflict zones. Or is there another way for us to do that? Do we limit carbon emissions by, instead of electric vehicles, and using that as a metric, maybe it's number of miles driven. So is number of miles driven in an internal combustion engine something, or number of the percent of people with vehicles at all, right? So these are the things we have to think about. I think we have to be objective and scientific when we're thinking about ESG related policies. I think we have to, try our best to put the politics aside and be scientific as much as possible. But I think this is the most important thing. I think everyone has to be at the table and agree on the need for us to understand where we're going, and then have that North Star, as I like to say, of where we're going in order for us to have this conversation. Else ESG will never get to a point that it could be usable to maximize output for society. Thank you.
Thank you. I think where you ended is where I'd like to start. And for those folks who are interested in asking questions, if you could make sure you raise your hand and we'll get your name down. So, looking into the crystal ball and just trying to project going forward, we've spent a year, three meetings, it's our last meeting, talking about ESG. It was never to create a model, it was to bring forward conversation about what is going on in the space out there in the industry. It's our responsibility to look at everything that's out there, and is there a policy that needs to be made, conversations to be had, and just trying to figure out where do we go from here relative to ESG? Is this something that is going to be staying with us forever? Is this one of those, it sounds like a hot, item, and I thought it was interesting to hear about State Street, BlackRock, and Vanguard, and I won't get on my soapbox about some of the practices that they've been working on, especially as it impacts folks and social impacts in housing, but wanting to know, where are we going with this? Is this just something that it was hot and sexy and it sounded great and we got these folks to bring this forward and it's caused an uproar, and even it brought conversations to organizations that maybe they weren't having? It's uncomfortable, people don't like to hear about it, let us just do whatever we want, we have to report to the feds, we give them the information, we have to make money for our shareholders, yes, we need to make sure that our workers and customers are happy? Or is this something that will be more formalized, because it's been very hard, even through this whole year, trying to get a definite what is E, what is S, G? Can you give me the exact definition? So what is happening? We leave here after we've talked about this for a year. What do we take home, and what's going to happen going forward?
Yeah, I mean, I don't think, it's going away, right? I mean, clearly there's been some shift in capital flows. I think the premise that that there was such a thing as a free lunch, and that, you can just throw money at this and it's going to outperform the market, which, you had some data points showing that, largely because tech companies did great and oil companies didn't, but that's changed in the last few years. So I don't know that it's going to just swallow up the whole market. But in terms of regulatory structure, I mean, it's ongoing, and it's ongoing at a breathtaking pace. I mean, we can't keep track of it. Under executive orders from the White House, I mean, we've got sort of a whole of government approach to some of these issues, and you've got rulemakings across the administrative state through all the alphabet soup of agencies, with cross-cutting compliance issues, all of which are going to indirectly influence insurance, even though it's a state-regulated concern. So, what do we think about it from state level going forward? I mean, I think we do need to think very carefully in terms of the investment strategies of these insurance companies, and we've got two different states, here going kind of the opposite direction. I think a well-crafted version of the Texas bill would be something I think would probably make a little more sense, in the sense that if you read the bill, they're very careful to say, we're not saying you can't consider these factors if they're financially significant. But where there's a tension, the financial factors have to predominate there. And if you're talking about the pools of risk for pensions and insurance investments, I think that's really important. And the other thing to think about from a state level, and it's something that's a little outside state legislators' ability to control, because so much of it's done at the federal level in terms of the securities regulation piece of this. But it could, if the securities regulatory environment affects companies differently, i.e. if they're SEC-regulated companies, they're publicly traded companies, if they're affected differently than other companies based on the compliance costs, and I was glad to hear Mr. Newsom talk about the importance of these compliance costs for the companies, it could affect winners and losers in the insurance market, because you have mutual insurance companies out there, you have publicly traded insurance companies out there. They're going to be operating under a separate set of rules in terms of their ownership structure, and one set of rules governed by the SEC and another set of rules governed by something very different. So I think it's important to keep thinking about it. I don't think it's going to go away.
I would I would totally agree with Mr. Copeland's perspective that this is not going away. I think that regardless of where you are, how you want to define either one of those, there's been progress made. There are standards there. There's a reporting structure that many of the publicly traded companies are reporting on. So there is some level of consistency in reporting. So you can make the comparisons. I think that companies that are not publicly traded are, as competitors, are having to do the exact same thing. So I think all of those things stay and we move forward. The question, I think, comes down to, one, what is the standard of how that's going to play out down the road? Can we find a standard that people can disclose and report their information, making sure that it's transparent, versus here's the standard and then here's the deviations across states or across jurisdictions that companies are going to have to deal with? That's the first thing. And the second thing is, as we talk about the costs, whether it be compliance or whatever it is associated with companies, the reality is that's also going to hit consumers. It's not one of those things that, well, I'm going to capture it here and that's the only place it goes. So when we sit and think about this and we talk about all the things that we may want, I really do think that from a public policy perspective, it is important that you all also evaluate that I'm getting the answers that I want, but there is going to have an impact on consumers. And because at the end of the day, that's how the business is basically run. So yes, it's going to be around. I don't ever see it going away. I don't think it should go away. And I don't think you'll find companies that would say it would. We can report on that. But if companies are reporting, there's a consistency, there's a standard that allows them, to be compliant, all those things work. But then when it becomes, as people have mentioned, the political issue of whether I like your answer or I don't like your answer, that becomes a different issue. And that's where I think, even though it stays, it becomes muddled. Because we're not talking about, okay, are we making progress? Are we reporting? Is it consistent? Can you make appropriate comparisons? Are companies being able to be financially responsible? All those things, because now we're throwing in another set of people's attitudes around, well, I like it this way, I like it this way, and that is only going to create it being muddled where we actually aren't addressing the real issues. And it doesn't matter what your definition of environmental is, we should be addressing some environmental issues. It doesn't matter what you think of social issues, we should be addressing some of the social issues. And I will tell you, as a member, as a person who accepts liability as a publicly traded board member, from a governance perspective, we actually know there's real issues in ESG totally, whether or not we make EVs. Doesn't matter whether we make EVs or not. Doesn't matter. We have to think about what our carbon footprint is for our building. So I don't think it goes away, but we're sitting here as companies and folks that are involved in this saying, we'd like some guidance, but we'd really rather keep it on what is it we're trying to accomplish in terms of the reporting and the information we're providing, so that we make sure we give you what you want. But when you say that we're now going to bring the political component in that as part of the debate, well, now it is going to get muddled, and people are going to wonder, is there real value in this? And that's really not what we should be doing, because there is value. It's just how we're going to go about doing it.
Senator Diaz?
Thank you very much. I have kind of a commentary that will have a lot of questions involved in it. Thank you, Mr. Newsom, for the shout out. I appreciate that. But I'm going to start with fundamentally disagreeing. We can't fix something we haven't defined. So what is the purpose of ESG in the first place? Is it human flourishing? Or is it sustaining the earth regardless of human flourishing? If so, let's define that before we make governing decisions based upon it. And then honestly, for some of these major investment firms, I don't think human flourishing is the end goal. I've heard WF speakers where they were attending talking of reducing the human population significantly. So for them, human flourishing is probably not the goal unless it's fewer humans. And then you mentioned fair a lot. So what is fair? Is it insurance being able to directly rate based upon risk, or what other factors do you think should be correct considerations within that? Risk exposure. How does ESG lessen risk exposure, and has that been quantified? So if, for example, we're talking about wildfires, there's a major disagreement between the environmentalists who don't want to see managed forests and potentially risk endangered animals, endangered species, and those who believe it should be aggressively managed in order to directly impact and lessen the risk for fire. And then lastly, when it comes to investing, what are insurers supposed to do? Are they supposed to retreat from their fiduciary responsibility in order to step into an area where we have almost zero metrics? And then this is my last concern, had to do with the SVO expansion. When the regulators make a determination for ESG being a part of what is a valid investment or what is a correct assessment, I don't want that to be a part of it until we've fully defined what our goals are and what the metrics are within this space. Thank you.
I think I'm going to address at least one of your questions, and I think you make some incredibly important points. I'm going to give my example when you talk about stakeholders and what's the overall purpose. And I think this is one or two of your questions really hit this. What are we trying to measure? Do we have consensus on what we're trying to measure? And then the perspectives. And whenever I give these talks, I didn't work this in before, but you think about the wind farm that's sitting in the Gulf, the Gulf of Mexico and Hurricane Alley versus a coal plant that's sitting in Michigan, which is fairly climate, has fewer climate risks. I'll put it that way. So, when I will say the initial rating methodology from the rating agencies when they first rolled out some of the methodologies for rating municipal bonds for state and local government, they really looked at impact almost in parallel, if not more, less important than risk profile, right? So are you adapting? Have you identified what your climate risk is, how prone you are, and are you adapting to that climate risk more so than the impact? But a lot of consumers of ESG information believe it's more of a responsibility metric. So there's a misalignment. And I think I don't have the answers to your question, but I will say something that's a little bit more idealistic. I think this goes back to what I mentioned before, my open. I think that is it's almost idealistic to say this, but somehow we have to ask ourselves, and that's why different perspectives, and I hate to say different political ideologies have to be in the room to get to this point where we agree on at least what is, maximum, I'm going to say maximum output, right, for each of those stakeholders, the insurers, the consumers, those in society that are, I'm going to say less prone, that are more in need of societal support. So what do we do? And I don't know the answer to that question, but I think it's very important for us to at least start to say ESG, this framework, this methodology, this principle could be used to help us get to, I'm going to say maximum societal output. But the problem is you got to get everybody at the table and at least agree to be in the conversation. So that's really the way I see it.
Thank you for the question. I'm going to try to quickly address a few of the things that you said related to definitions of fairness and some of the comments you made regarding sort of who's responsible is maybe the way I interpret it. But part of the challenge, and it's part of what I was trying to highlight as I went through my comments, is that there is no necessarily one pure definition of fair. And that's part of the challenge. I could make a number of statements about how insurance rates should be set and what they should accomplish, and all of them can be true. Rates should be actuarially fair. In and of itself, I don't think that you would get a lot of disagreement about that statement. Rates should be affordable for consumers. Again, around the table, I think that's a fair statement. Insurance should be available. The process should be transparent. There are a number of things that I could describe about the process individually that all are ideal goals. What happens is when you begin to realize or when you begin to attempt to satisfy all of those criteria simultaneously, you realize very quickly that that's a fool's errand. You can't do it. And so then the challenge becomes making the appropriate decisions, informed decisions, about how we want to balance all of those criteria. And the only way that can be done, at least in my opinion, is by having all of the appropriate stakeholders around the table, insurers, consumers, regulators, all the folks that have a stake in that decision, so that we go in, I think, with informed information to be able to make the decision directly. The challenge happens sometimes is that there are attempts made, broad attempts made by implementing some kind by implementing a policy or a regulation that doesn't necessarily get at all of these things specifically and doesn't directly address that balance. And I think that potentially applies to your question about the wildfire, different opinions on exactly what should be done. But we never really get anywhere unless all of those key stakeholders are at the table and having that conversation. And I get that that's a challenge. I understand that. But it still is going to create some ultimate challenges. But ultimately there's the definition of really what's fair, but if you think about that ultimate responsibility, and the Insurance Information Institute has put out a number of white papers on the idea that part of the responsibility is not just for insurance companies to be able to predict what the risk is, but for insurance companies collectively with all of the other stakeholders, government, consumers, to understand how to be able to invest in a longer term strategy that helps to mitigate a lot of the things that we're facing. So not just understanding what wildfire risk is today, but how do we address it so that we can actually mitigate that risk in the future. That's a longer term strategy, but I think there's, again, a collective responsibility that we don't just understand how to satisfy some of the principles today, but how do we make the situation better for the future.
We're going to go to Representative Bennett.
Thank you, Madam Chairman. I've enjoyed this series the last few meetings, and in previous meetings we've discussed obviously the environmental piece, and we had touched on the issue of discriminating against oil and gas. I'm from Oklahoma. I represent a district in Oklahoma City, and we were cautioned, I cautioned our legislature against adopting what they call anti-ESG legislation, wherein the state is not allowed to do business with anyone who, quote unquote, discriminates against oil and gas. What that has practically caused is cities and towns being limited in where they go in the bond market, effectively costing them millions of dollars more to raise capital in a place where the state actually hamstrings our municipalities anyway in the way that they can raise money. So in previous sessions, the overwhelming take, I think, from sort of right of center has been we need to take a wait and see approach. We should not be dictating any terms. And yet, when it comes to the G portion of this, and in this particular case, I'm thinking of that governance as what the state or what other governmental entities are doing, we have taken, just in this one case in our state, a not wait and see approach, but a do and then think about it later approach, which has effectively cost our citizens a lot more money. One thing that I hear a lot in this conversation is this needs to be centered around fiduciary responsibility. And my view is we have a fiduciary responsibility to our taxpayers, and I'm going to have a hard time explaining to taxpayers why it's costing them millions of dollars more to fund things. So I guess my question is, should we be taking a wait and see approach in all areas of ESG, or should we be taking a go after it and then deal with the consequences later approach like we've done in Oklahoma?
Yeah, I mean, I don't know that dichotomy is exactly the right framework, but I agree with you that, some of the backlash legislation can be overreaching in this sort of thing, and for the same reasons we don't want state policymakers, trying to lean heavy on these E&S criteria in a way that might compromise your investment returns on the one hand, it shouldn't be on the other hand either. I understand the sensitivity when you've got certain big financial actors punishing your state industries, but I don't know that that's the right way to push back. I think there are probably alternatives to do that. I don't know that wait and see is right. I do think that the prior questioner's point on definitional clarity is really important. And I'm skeptical of the notion, I guess, that you can just sort of get all the stakeholders at the table and come up with all the right answers on these sort of questions. I mean, the rules matter, right? The enforcement mechanisms matter. I mean, Mr. Nichols originally said, well, it doesn't really change whether the government plays a role. I think that's wrong. I mean, I think it is correct that a mutual insurance company will also be under ESG pressures, just like a publicly traded company. It's not true, however, that a disclosure rule from the SEC that applies to a publicly traded company won't affect them differently, that you won't have 10b-5 shareholder class action litigation against the one and not the other, that you won't subject one company and not the other to a Martin Act investigation in New York. So I mean, these things really matter a lot, and I think these costs are underappreciated. The direct compliance costs that Mr. Newsom quite clearly and accurately represented are significant, but these collateral costs of enforcement are perhaps more important. What you're going to enable are people on both sides of the political aisle potentially to litigate and to enforce with government actors along these rules, and they're not clear. If you're talking about an ordinary false financial disclosure, I mean, you can look at the accounts receivable, you can look at the accounts payable, you can look at what's going on. Here, there's not a clear consensus, which creates ambiguity and increases the potential for mischief here. So, yeah, but I'm with you. I don't think a sort of divestment strategy is almost ever warranted in these sorts of situations. And I certainly wouldn't take a sort of hatchet approach and just the compliance costs are huge, and it might well increase your municipal bonds. There's a better way to push back. Thanks.
If I may, I want to congratulate you, first of all, to be in the state of Oklahoma and to not buy into the anti-ESG, I call it the hysteria, is correct. It's tempting from a political standpoint, in my humble opinion, but I think that that's the wrong answer for all the reasons that we've all talked about here today. I think that you have to be at the table. Let me give another example, going back to electrification of vehicles. Let's call this a metric. The president, again, forget about political affiliations here. Let's look at it objectively. The president said that he wants 50% of all American U.S. sales and vehicles to be 50% electric by 2030. Now, if that's the metric, as opposed to carbon emissions, as opposed to impact on climate change, if electrification is the metric, we might have a little problem. 7% today, and right now that percentage of electric vehicle sales to total sales is plateauing. Or it's accelerating at a lower rate, right? In fact, the automotive OEMs have reported billions of dollars in losses and backing out of several investments that they had in battery joint ventures, electric vehicle plants, et cetera. So we got a problem if that's the metric. If the metric, however, I'm not saying this is the right way, the most cost-effective way to address the metric, but if the metric is carbon emissions, is there an ICE plus carbon sequestration approach strategy, or is that part of a strategy we need to be looking at? I don't know the answer to the question, but I want to have that conversation, and I want to have that conversation objectively. What's the right mix? Should we be pumping billions of dollars, as we have, into electrification of the entire American, all American retail sales, or is there some sort of a mix where we maximize the output of the metric of carbon emission reduction, or again, impact of climate change? Right? And so that's where I think it's important for people that are looking at it from both sides of the aisle, if you will, to be at the table. But, taking your ball and going home, for proverbially speaking, is not the answer, in my humble opinion. Thank you.
We need to move to Senator Lang, and then we're going to close with Representative Young. If we could be concise with our questions, please. I hate rushing folks, but we are moving on time.
Thank you, Chairman Hunter. I'll try to be brief, Mike. Question, I guess, follows up on my friend from Oklahoma. The market will ultimately dictate if this is around long-term or not. So it's, for any of us that think we can read what's going to go on in the market, we're making potentially a mistake. Ms. Copeland, I'm glad of the work that you guys are doing in challenging this. As you know, about 130 years ago when we created the corporation laws, our Congress gave our businesses a superpower that never existed in the world before, limited liability. And in return for that limited liability, as pointed out, they must always put shareholder value, not stakeholder value first. So it'll be interesting to see how your lawsuit works out. My question, though, comes down to this. I'm conflicted. Personally, I'm anti-ESG. I've been in the securities business over 30 years. I can show you, we now have empirical data that show these funds are 3% lower return than non-ESG funds. And to be clear, I get it. Past performance is no indication of, so if anybody's from compliance is here, I'm not suggesting that's going to continue. So I think it's right for us as legislators to tell government and state government how they should spend their money. We should put our taxpayer dollars first, especially in our retirement plans. Our policemen, our firemen, our teachers depend on us to deliver on the promises, so we have to make sure our funds are getting the maximum return. But as it relates to the insurance industry and others, I struggle with that because the executives in the insurance industry have access to the same data that we have, and they will either enjoy the benefits of good decisions or suffer the consequences of poor decisions. 3% lower return, for example, might correlate to higher fees, charges that they have to make, premiums, which will give them a competitive disadvantage in the marketplace. Am I wrong to say leave the private sector alone while I'm saying let's tell the government what they can and can't do? Thank you, Madam Chair.
Yeah, I mean, clearly the pension funds are the principal vehicle, I think, that state lawmakers ought to be looking at, precisely because you're exempt from ERISA. So whatever the DOL's doing, this is, and these are a huge chunk of your future liabilities for government. So yeah, I mean, I would have a pretty light touch with the insurance industry regularly. I mean, I think the important thing is to do something like what they did in this Texas bill that was disseminated, which is, if you're doing something involving ESG, nothing's going to say you can't do it if it's financially relevant. I mean, I was on record, I have a comment criticizing the proposed rule on climate disclosure at the SEC introduced in spring of 22, but I'm on record saying that the earlier guidance from the SEC saying that, if it's material, you disclose it. Of course you'd want to disclose it if it's material. And some of these are really important questions. And so the question is, are there other countervailing forces at play enabled by other regulatory bodies that are generating pressures on these businesses to do something that is adverse to the interests of their policymakers, the policyholders? And the answer may be yes, and it may differ depending on whether it's a mutual company or a publicly traded company. Now, but yeah, go with a very light touch on this. The last thing you want to do is tie the hands, because you're absolutely right. Unlike a passive index fund like BlackRock that is just replicating the S&P 500 and isn't really internalizing any of the costs if they get these rules wrong that they're pushing on corporations, these insurance companies are very much going to internalize the cost if they err.
We need to move to Representative Young, please. Thank you.
Thank you, Madam Chair. So once again, this freshman stumbled into a PhD room conversation, but I've been trying to keep up But this is good. So my colleague, prior to me getting the mic, pretty much touched on what I had written down, because I was trying to get some clarity on how this plays out within the public and the private sector. We can talk offline. Right now, what I'm going to end with is putting Mr. Newsom on notice that we'll be following up with you.
Yeah.
I'm from Wayne County. You said some things that have really piqued my interest, and so just know that we're going to follow up with you. Thank you for the time, Madam Chair.
Thank you. I appreciate everyone's patience and interest in having the conversation this year. It's been very interesting. There's been a lot of twists and turns along the way this year. And if we've not, I guess, learned anything, that we have a lot more to learn. I think that might be the one thing that we can all take away, that we've not answered the burning questions, I think. I think it's just prompted more questions. And hopefully those folks who have entertained us in coming to the panel, like yourselves, and would avail yourselves to any one of the legislators here at any time to be able to work through. I mean, every state doesn't have policy, but every ESG policy, but every state probably does have something within their Department of Insurance or in their comptroller's office, like mine does, that gives some insight into how to invest, how to divest. And I think this is probably going to be something that we continue to have conversations on going forward. I just want to close in saying this has been a real privilege to be able to have this conversation this year. I think that having conversations like this, just like we had conversations a couple of years ago about race and discrimination in insurance, why it may make some people uncomfortable and they don't want to talk about it, doesn't mean that it's not happening and it shouldn't be spoken about and worked through. And so as we move forward, I hope that we'll have similar interesting conversations that really dig down into kind of what companies are going through and how we as policymakers can make things happen. So thank you to all my colleagues for working through this with me. Are we having a break? Okay. So Will said we only get 5 minutes since we started a couple minutes late. So we're going to go into 3:15 property casualty, and thank you all for attending this meeting.